All right, let's get right into it. As a highly skeptical equity research analyst, I'm taking you through a completely objective, data-driven teardown of the telecommunications real estate sector. In today's explainer, we are putting two absolute titans under the microscope, Crown Castle and American Tower. We're going to strip away the hype, completely ignore the mainstream soundbites, and act as investigative journalists of their actual financial statements to figure out which stock is truly positioned to win in 2026. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Here's our roadmap for today. We'll be covering 1. The infrastructure real estate divide. 2. Crown Castle's strategic pivot. 3. Q2 earnings and cash flow. 4. Hidden flags and headwinds. 5. The valuation and dividend reality. And 6. The final analyst verdict. Part 1. The infrastructure real estate divide. Global scale versus domestic pure play. This brilliantly illustrates the duopoly at play here. On one side, American Tower wields a massive, sprawling global footprint. We're talking nearly 150,000 communication sites across more than 20 countries, plus a rapidly growing data center business. On the flip side, you have Crown Castle. They operate roughly 40,000 U.S. cell towers with a hyper-focus purely on domestic top 100 markets. It's a fascinating contrast. American Tower mitigates regional downturns with massive global diversification, while Crown Castle, well, they've doubled down entirely on the U.S. 5G rollout. Now keep in mind that both of these heavyweights operate as REITs, or real estate investment trusts. That means their lifeblood isn't selling a flashy consumer product. It's long-term lease stability and generating rock-solid cash flow. They lease essential vertical real estate to tenants like T-Mobile, AT&T, and Verizon. As long as those tenants consistently pay rent, the REIT basically prints money. Moving on to Part 2, Crown Castle's strategic pivot following the massive 2026 divestiture. So after years of slower-than-expected returns on that 5G rollout, Crown Castle radically shifted course. Unlike American Tower's steady global accumulation, Crown Castle executed a massive domestic teardown. Step 1, on May 1st, they successfully closed the sale of their fiber solutions business to Zio and their small cell business to Arium, walking away with approximately $8.4 billion in net proceeds. Step 2, they took that cash and aggressively repaid more than $7 billion in outstanding debt. And finally, Step 3, they executed a $1 billion share repurchase program. Management is clearly executing a much leaner, pure-play tower turnaround strategy. The absolute crucial point here is the impact this had on the balance sheet. That aggressive $7 billion debt paydown significantly improved their leverage. It dropped their total debt from a towering $24.3 billion at the end of 2025 straight down to $18.2 billion by the end of June 2026. This is a classic financial engineering move to buy some much-needed breathing room. Part 3, Q2 earnings and cash flow. Let's peel back the 10Q filing. Look, the mainstream media loves to fixate on a top-line revenue decline, which hit $1.01 billion. But any serious equity analyst knows that the true lifeblood metric we need to track for a REIT is AFO, or adjusted funds from operations. This metric strips out non-cash items like massive real estate depreciation to show us the actual residual cash flow available for dividends and sustaining capital. And notice the stark divergence here between revenue and cash flow. Despite site rental revenues dropping due to the divestiture and some customer churn, their Q2 AFFO per share actually jumped 11% year over year. It went from $1.02 per share in 2025 up to $1.13 in 2026. That significantly beat analyst consensus estimates of 99 cents. Driven largely by better operational efficiency and an expected $165 million decrease in interest expenses, thanks to that massive debt paydown we talked about, management has confidently raised their full-year 2026 AFFO midpoint guidance by $5 million, bringing it to $1.975 billion. This operational guidance gives them the exact cash flow breathing room required to compete in a domestic market that is largely dominated by American Tower. Section 4. Hidden Flags and Headwinds. The analyst's 7+7 reality check. Let's dig deep into the footnotes and uncover 7 deep red flags. Number 1, a massive 90% tenant concentration with just 3 carriers. Number 2, the looming Dish bankruptcy. 3, a lingering $20 million Sprint cancellation headwind. 4. Extremely tight liquidity, with a 0.3x current ratio. 5. Negative organic site rental growth. 6. The physical threat of U.S. wildfires to domestic infrastructure. And number 7. Technological shifts toward network virtualization that could reduce overall tower demand. So why does the financial media just ignore these? Because evaluating localized tenant concentration and tight liquidity ratios is honestly just too complex for a quick soundbite. But let me tell you, a tight 0.3x current ratio means short-term liabilities exceed current assets, which makes any sudden shocks highly dangerous. And speaking of sudden shocks, the heaviest anchor dragging on Crown Castle right now is a massive $3.5 billion material litigation claim against Dish. Since Dish entered Chapter 11 bankruptcy on June 30th, the recovery of this massive asset is now trapped in highly complex insolvency proceedings. This creates a volatile $220 million headwind in terminations alone just for 2026. American Tower's massive international diversification completely insulates them from single-carrier domestic shocks exactly like this one. But hey, let's flip the coin. We also found 7 green flags buried in those filings. 1. That $8.4 billion cash injection. 2. The highly successful $7 billion debt deleveraging. 3. Interest expense dropping by $165 million. 4. They executed a $1 billion buyback at a great average of $88.66 a share. 5. Net leverage successfully hit their target range at 6.3x. 6. That 11% Q2 AFFO per share growth. And 7. Net margins recovering to 10.4%. Why the media blackout on these? Because systematically repairing a balance sheet with divestiture cash just doesn't generate the same panic clicks as a top-line revenue miss. But as analysts, we see these flags for what they are: a company aggressively optimizing its capital structure and buying back stock well below intrinsic value. Part 5. Valuation and dividend reality. Let's look at the multiples. The baseline multiples here are pretty stark. Crown Castle is trading at a steep 44.2x forward price to earnings premium compared to American Tower's 29.1x. But as analysts, we don't stop there. We have to run the ultimate valuation gauntlet. We ran Crown Castle through all 21 of our models, from standard DCF and unlevered free cash flow in Group A to perpetual growth DDM and EVA in Group B, right down to liquidation value and Black-Scholes real options in Groups D and E. The result? It yields an intrinsic value hovering right around $102 per share. Now let's do a reality check using the legendary investors. If we apply Ben Graham's deep value formula, Crown Castle completely fails the net current asset value check with a Graham number way below its trading price. Peter Lynch's PEG ratio flags the organic growth as simply too slow to justify that high PE premium. And Warren Buffett? He'd likely balk at the shrinking return on invested capital and the higher net debt to EBITDA ratio when compared directly to American Tower's pristine balance sheet. So, how are they defending that premium valuation? With one incredibly attractive number, a 5.6% dividend yield. For a pure-play real estate trust, this yield is the anchor keeping income-seeking investors from jumping ship while management tries to navigate the turbulent Dish bankruptcy and this massive post-divestiture restructuring. Finally, Section 6, the final analyst verdict. Let's synthesize all this data. First off, based on the aggregate of our 21 model valuation gauntlet, Crown Castle currently screens as fundamentally overvalued, meaning it's going to require absolutely flawless execution to justify its current premium. Second, let's look at the economic moat. American Tower possesses a wide, actively expanding moat built on network effects and cost advantages across multiple continents. Crown Castle's moat, on the other hand, is grounded purely in efficient scale, basically the sheer difficulty of replicating its domestic towers. But make no mistake, that moat is undeniably shrinking in the near term as they shed their fiber network and retreat into a highly concentrated U.S. trench. Ultimately, American Tower is far better positioned to deliver steady, lower volatility growth. Crown Castle is offering a much higher risk turnaround strategy that relies entirely on systematically destroying its debt and legally navigating out of massive customer bankruptcy disputes. The valuation multiples suggest one reality, but the structural pivots and buried bankruptcy claims suggest a totally different one. The models are pointing one way, but those hidden flags definitely suggest a storm is brewing. So, which side of this telecom divide are you investing in? Do your own homework.